Roth accounts are a great investing and tax planning tool, and like anything, the IRS makes them as complicated as can be. In this video, we'll cover 8 Roth hacks that you can use to maximize their potential on your path to financial independence. The first one is a Roth conversion ladder. Now, you may be aware that the required age for making qualified distributions from a Roth account is 59.5 years old. However, there are a couple of ways to crack into those counts a little early. One is a Roth conversion ladder. The process is not terribly complicated, but it does involve a lot of steps, and the most important one is you need to begin planning at least 5 years in advance. We have the nuts and bolts of this in another video about Roth conversion ladders. We'll link it above and in the description below, but basically what you're going to do is take a traditional IRA and begin converting sums from that account into a Roth IRA 5 years before you need to make distributions. That's because each conversion has a 5-year clock. The IRS states it must sit in the account for 5 years before any earnings or growth can be withdrawn. The good news is at the end of that 5 years, the IRS looks at that conversion much the same way it does a contribution, meaning those funds can be withdrawn even before age 59.5. If you want to retire early and have a series of withdrawals from the Roth IRA, the Roth conversion ladder allows you to stage these conversions so that you can begin making withdrawals 5 years after each conversion and serve as a bridge into retirement. Number 2 is Rule 72T, or series of equal periodic payments. Now, this is another way to access the funds in your Roth account early. A 72T distribution is basically an agreement with the IRS that you'll remove funds from a retirement account like a Roth IRA, traditional IRA, and you'll do them in a series of equal periodic payments calculated 1 of 3 different ways. There's a minimum distribution method, an amortization method, and an annuity method. This provides an option for you to remove funds from the account early without penalty. The only catch is you must keep the withdrawals going for at least 5 years or until you turn 59.5, whichever occurs later. So if you start this when you're 52, you'll have to keep it up until you're 59.5. If you start it when you're 57, you'll have to keep it up till age 62. Now, 72T distributions can be a little challenging to manage. I highly recommend that you reach out to a tax or accounting professional if you want to go this route. Number 3 is a spousal IRA. One condition of contributing to a Roth IRA account is that you must have earned income. There is an exception to this, though. Non-working spouses are allowed to make contributions to IRAs using the income of their working spouse as a basis. As long as the working spouse has enough earned income to cover both their contribution and the contribution of their non-working spouse, the contributions to IRA are completely legal. Now, you do have to file your taxes as married filing jointly if you want to do this, so just keep that in mind. And once again, we've already done a video about this, which we'll put a link to in the description below and maybe overhead. Number 4 is a Custodial Roth IRA. We've already said that you have to have earned income in order to contribute to an IRA. However, there is no restriction based on age. This means that even your minor children can contribute to an IRA as long as they have earned income that's been reported to the IRS. Now, if you know much about Roth IRAs, you know the longer that you can keep money in the account, the more valuable it is. So Roth IRA is potentially even more valuable to a child than it is to an adult. So if your kid has earned income, you can set up a Custodial Roth IRA with just about any investment company. You'll be the legal manager of the account until they reach the age of majority, at which point they'll take over. Now, once again, this has to be earned income that's reported to the IRS. So cash that's earned from mowing lawns or babysitting, things like that, you can't contribute that to an IRA unless it's also reported. In many cases, parents decide to use this kind of like a 401k and make a matching contribution based on the amount of money their kids put into the account. Number 5 is converting your leftover 529 funds into a Roth IRA. Now, this is something new that beginning in 2024 you'll be allowed to do. Basically, if you have a kid or a loved one who's finishing college and you have a 529 account where they're the named beneficiary and there's money left over, you can move it into a Roth IRA, tax and penalty free. Now, the recipient of this generous gift will need to have earned income to cover the amount that's put into the Roth account, but it's potentially a great way to get them kick-started on Roth savings while not also wasting the money that's in the 529. Number 6 is the Backdoor Roth IRA. In addition to having a requirement that you have earned income to contribute to an IRA, you also can't have too much of it. We'll put the brackets on the screen here, but basically once your income reaches a certain amount, you're completely disqualified from contributing directly to a Roth IRA. You can, however, still contribute to an IRA on an after-tax basis, then convert the amount to a Roth IRA, and it's totally legal. So effectively, you take one extra step, and the money still gets in the Roth IRA. Now, there's some other things to keep in mind if you use the Backdoor Roth IRA. We have another video that goes through this in detail, which we'll again link above in the description below. Just know that this is an option to you, but there are some tax hiccups that you need to check out before you do it. Number 7 is the Mega Backdoor Roth. Now, while contributions to IRAs are limited to $6,500 in 2023 or $7,500 if you're 50 and older, after-tax contributions to 401ks can be all the way up to $66,000 in 2023 and $73,500 if you're 50 and older. That means there's basically 10 times the room for contributions in a 401k that there is in an IRA. Hence the name MEGA. Now, to do this, you'll contribute on an after-tax basis to an employer-sponsored 401k plan, then convert those funds to a Roth account, allowing you to contribute potentially tens of thousands of dollars to a Roth account every year. And if you want the funds in an IRA and your employer allows, you can do an in-service rollover from the 401k to a Roth IRA, so the funds end up there. Now, all 401k plans are unique and different, so you need to look into your plan documents or contact your plan custodian for details on whether or not you can actually do this. Number 8 is remove contributions tax and penalty free. Last and most certainly least, you can remove contributions to Roth IRA accounts completely tax and penalty free at any time. I will admit that this is a feature, but you shouldn't use it if you can help it. The reason is once you make a withdrawal from a Roth account, you can never put it back. It's gone for good. In other words, you're forfeiting all the future earnings and interest that you could have made from that contribution had you just left it in the account. Instead, I highly recommend that you have an emergency fund of 3 to 6 months of expenses so that you can pay for emergencies or issues out of pocket instead of raiding your Roth. So there you go. That's 8 ways to maximize the potential of your Roth. I hope this was helpful to you. If it was, please click like and subscribe. As always, we're grateful for your time and grateful for your attention watching our videos. God bless and take care.